Good morning, everybody. This is Ben and Greg, and Steve will be here with us shortly. Can anybody give me a quick mic check? Make sure I sound okay.
Yeah, me too. Mic check.
Yeah, give Greg a mic check too. Hold on, Steve boy. All right. Well, I guess we sound okay. So Steve should be here any second. Guys, today we are kind of picking up where we left off last week, talking about credit spreads, which we find to be a much safer way for trading options, for selling options, actually. We're playing the other side of the fence. So I know this is an entry-level class, but we are going to continue to roll into more depth here. We've got Greg, who's been looking at some cool trades that he's going to talk about this week, and let me add Steve real quick. Steve, good morning, sir.
What up?
So like I was telling everybody, Steve, I know you missed this last week. This is a continuation of our conversation on credit spreads and basically selling options. We're on the other side of the fence here. We think it's a much safer way to play options. And Greg's going to talk to us about some things he's been looking at.
Yeah, that sounds great.
Cool. Greg, you just want to kind of start us off, just kind of for anybody that wasn't on last week, just kind of recap credit spreads, just quick breakdown of the basics.
Okay, let's go ahead and do that. When you buy an option, you only make money if the option goes past where you want it to go. You have a high chance of actually not making money and losing every penny you put in. We want to be on the other side of that trade by selling options, and that's credit spreads. Okay, it's a great way to generate regular income. All right, so if you trade options, you already know this. Okay, options work when you buy a call, you profit when the stock rises above the strike price, so you want that to happen. When you sell a call, you're on the other side of that trade. You profit when the stock does not rise above the strike price. Okay, so that means that you profit if the stock, if it just sits there, if it goes down, or if it goes up just a little bit, but not far above the strike price. Okay, so that's why it's so good. It works most of the time. Okay, and it's the opposite for put buyers and sellers. A put buyer, of course, wants the profits, will make profits when the stock falls below the chosen strike price. The put seller is going to profit whenever the stock does not fall below the strike price. All right, so it's pretty simple and straightforward. You just got to make sure you think of it the right way, being on the other side of the trade. All right. So with credit spreads, you've got a bullish credit spread when you think the stock will go up. So you want to sell a put option down below where you don't think the stock is going to go. Typically, that's going to be below a support point. The support can be a price, or it can be a trend line, like the 50-day moving average is a big one that institutional investors look at, or the 200-day is the granddaddy of them, of the moving averages. Okay. Then you've got the bearish credit spread. You think the stock will go down. And so you're going to sell a call above current prices where you don't think the stock will go. And that's going to be above resistance level. Now, for a bullish credit spread, you're going to sell a call above the stock price where you don't think it's going to go. But for protection, in case you're wrong, you buy a higher priced call option, a higher strike price that's going to cost you less. So you're going to get immediate credit, and you are protected in case the trade goes the wrong way. And likely the same way with a bearish credit spread, you think that the stock will go down. So you're going to sell, I think I said that backwards. You're going to sell, if a bearish credit spread, you're going to sell a call above current prices and then buy a call with a price that's higher than that. Let me say that again. For the bullish credit spread, you're going to sell a put below current prices, and then you're going to buy a put for protection that's even a lower strike price. Okay, so let's show how that actually plays out.
Let me pause real quick, Greg. So appreciate that recap. Does anybody have any questions on what that actually is? Anything in that general sense of what a credit spread is?
Make sure I said it right.
I think you got it. When the flip, you got it. But
okay,
for anybody that is new to this, we're recapping what we did last week or what we talked about last week. We're going to take a deeper look, but I don't see any questions.
These options are a little tricky if you're not familiar with it, but once you become familiar with it, it's really not very tricky. Okay.
I'm going to give you full. Should I give you full screen here? I'm going to give you full screen. Okay. Go for it, Greg.
Okay. So this is a trade I did a few weeks ago. I placed the trade on August 18th. And the crosshairs here on the chart is what I was looking at on that day. I cut off everything that has happened to the right of that, and I erased it so you can't see it. This is what I was looking at the time. This is a bullish credit spread because I'm saying that booking holdings is going to bounce off this support level. It's been overall in a strong uptrend over the last few years, but it had a little pullback, and now it's bouncing off a support level. Before our crosshair day, it bounced off it twice in this chart area here in the previous few weeks. So it's showing you that it's got support here because it's bounced off support. The buyers has jumped in twice during that time. So how do you trade it? So what I did, you notice that the current price of the stock at that time was $2,086.31. So it was August 18th at the time. I sold a September 10 put, which is about 3 weeks out at that time. I sold a 2080 put, which would have been $6.31 lower than the current price. I'm saying it's not going to go below that price, but if it does, then I got to cover myself for protection by buying a 2070 put. Okay, another $10 below. Now to buy the 2080 put, you got to pay $4,550. That's what the price is there. To sell it. To buy the 2070 put, I had to pay the $4,200. The difference is the credit that you make, which is put instantly in your account. That's $350. Okay, so that's what it looked like. So here are the stats for this trade. An immediate credit of $350. Here's the risk on the trade. You calculate risk by determining the vertical spread between the two options, which is $10, 2080 minus the 2070. Then that's your risk less the credit, which was $350. So on this, the credit was $350. The potential maximum loss was $650, a little over double or about double. And then that helps you determine where your break-even point, which is $3.50 below the nearest put. So that's actually should be 2080, not 2070. So it's 2000. So it's 350 under 280, which would be 2075 up there.
Got it. Steve, any questions?
27,650.
No, that makes sense. No, that makes sense.
Okay, going this pretty fast. Let me show you how this played out on this trade, okay? I was absolutely right that it did bounce off support, and it bounced up pretty hard and jumped up to a higher level. Okay, it doesn't always do that, but it worked out perfectly this time. Let me show you one thing that you need to know about this, though. You see the crosshairs on this trade. That's the day I entered the trade. The following 2 days, it went slightly below where I sold the put. And that means that the put buyer has the option to exercise the trade at any point it goes below the put strike price. So in other words, I sold a 2080 put. It did go below that briefly for 2 days. That means I could have been exercised, but I wasn't. Most of the time, just because it goes briefly in the money doesn't mean you're going to get exercised. What that means is the put buyer exits the trade, and your broker will force you to exit your trade at a loss, basically. Okay, that happens once in a while. Most of the time, it doesn't happen. I would say maybe 1/3 chance of it happening in this situation or less. Okay.
So, can I ask a couple questions real quick?
Yeah, go ahead, please.
Okay, so I'm assuming a lot of people, so they can either sell the option, correct?
Yeah.
Or they can exercise it. So am I assuming right? If it briefly goes below the strike, right, where now they're in the money and you're out the money on the 280 sell put, is it safe to say that a lot of them don't really exercise or sell because maybe they're trying to get a little greedy, hoping it goes down a little more?
Yeah, absolutely. Think of it as if you were the put buyer in this situation and the stock goes a little bit in the money. What do you want to do? Well, some people might exit with a little profit. A lot of people are holding on, hoping to make a bigger profit, right?
Mm-hmm.
And so there was only 2 days after our entry point where they could have made a profit, a small profit. Okay. And it could have happened. Some people, like, for example, let's say 10 of us did this exact trade. A few of us, maybe 2 or 3 of us, would have been exercised this trade as selling the put buyers. A few of them would have exercised it possibly. There's no way to know if we would have been assigned on this or not, if we would have been forced out of the trade as a seller of the put. There's just no way to know. And if 10 of us had done this trade, some of us would have been exercised and most of us wouldn't have. Does that make sense?
Yeah, I mean, just something that stands out to me is it's funny, you know, a lot of people, everyone says, you know, 80% or whatever of just buying a straight call or a put, right? Exercise worthless. That's why it's kind of a sucker's game at time. You want to buy or sell these credit spreads. But it's interesting to me, at least the way I look at it, is not only do you have an advantage because you're selling a leg and then you're buying a leg, so you have that protection, right? But there's also a greed factor, really, that you can't really put on the chart. That, you know, like you said, like if I'm barely in the money, I'm probably going to hold out for something bigger, right?
Yeah, and that's actually the way it plays out most of the time. On those 2 days where I'm starting to make money as a put buyer, I'm hoping that things will get a lot better for me. Most of the time, you know, I'm going to hold out a lot longer, closer to expiration before I exit the trade. All I'm saying here is that there's a slight chance that you could have been exercised. It's about an 80 to 90% chance that that you would have made money if you had exercised or if you had put on this credit spread as selling the 2080 put and then buying the 2070 put. Okay.
Now,
I put a lot of details in here, but I just wanted you to know, all you really need to know from this is that there's a slight chance you could have been exercised in this trade. But you can see that it did bounce right off support down here at the 2080 level, and the trade worked out beautifully. All right. When I do trades, I'm looking at technical analysis. I'm looking at support and resistance and trend. I'm looking at that purple line in the middle of this trade. That's the 50-day moving average. And once again, that's a critical point to look at. And I'll show you as we go through this how to place trades based on that. Okay.
Can I throw in another question?
Sure.
How do you choose how far apart you want the legs to be?
Okay, good question. Most of the time, I'm going to do an option. I'm going to sell an option below support on this. So I chose the 2080 put based on the fact that it's right at the support level. I don't think it's going to go below 2080. Maybe briefly, like it did, but overall, no. I think it's going to bounce. And so I'm going to be writing a put below, or selling a put below where I think it's going to go. On the flip side, for a stock option, for a call option, if I think it's hitting resistance, the stock is bouncing up into resistance, not going to go higher, I'm going to sell a call option above that price, just a little bit above. Okay, anywhere where I think it's not going to go.
So like the next option available, or
usually, yeah,
above that limit.
Yeah.
Above, yeah.
Yeah. On this particular trade, 2080 was the closest thing that I could get. They're in like $10 increments, I think, if I remember correctly. Okay, so I basically sold the closest one that I could sell. Now, it may have even been $5 increments or 10. I don't really remember. But the risk versus reward was okay to do the 2070 put to buy it. So you can see the spread on this. I made $350. And the spread was $10 between the two options. And that was okay because I didn't think it was going to go down there, and I was right.
So you made $350. I can't help but to play devil's advocate, and I think this is just kind of great for engagement. Maybe I can say some things someone else is
go
thinking.
ahead, please.
But so you upsize 350. The risk is more than the upside. How do you offset that? Because I mean, the risk is worth more than the reward. The risk is more than the reward.
Right. So that's where you get into the fact that you have to be able to read technical analysis correctly. You got to read the charts the right way. Most of the time, the way people buy options is swinging for the fences.
Mm-hmm.
They buy out of the money options. They're far away and very unlikely to ever be reached.
Okay.
It's kind of like buying a lottery ticket, really.
Yep.
Low odds of success, but they're really hoping it goes there, they'll make a lot of money. But their odds of success are like really low. That's the way most of the people trade options, and it's a poor strategy. High odds of losing every penny you use in that strategy. Okay. So we're taking the other side of that strategy, basically, and we're taking limited risk here.
By buying buying the option in case they do hit that home run.
Credit spread, right. So we're selling the put where we don't think it's going to go. And in case something catastrophic happens, we're buying the 2070 put. Now, if you've got millions and millions of dollars, you can just go ahead and sell a 2080 put and not buy the 2070 put. But you've got to have a lot of money before your brokers will let you do that, because the risk is huge. Okay, most people don't have that kind of money to do a trade like that. But as long as you buy the 2070 put for insurance in case things go south on you, it works out. Okay, now let me show you the different ways that you could trade this. On the crosshair day that we were looking at, the stock is at 2086. There's a few things you could do. If you knew or had a strong sense that it was going to pop up like it did, you could buy a call at the money. That's one thing you could do. You could buy the stock outright if you wanted to. We're taking the other side of the trade and we're selling puts where we don't think it will go for income because it's a lower risk trade. Now that, let's look at booking holdings. Over the last week or so, it has gone mainly sideways. Now might be a good place to sell a call above where it is in the thoughts that it won't go higher. I'm just looking at the market this morning, and I see that the market is up, and yet I'm looking at all my stocks on my watch list, and there's a lot of red on my watch list. In fact, majority. And that's continuing what has been happening in the markets lately. A few of the key stocks, like the FANG stocks, Facebook, Apple, Google, Netflix, those are the overweighted stocks that are still climbing. But the majority of stocks are going down. Over 50% of stocks are in a downtrend right now. So with that much weight on the downside, I would prefer, I'm bearish overall, and I would prefer to be selling calls that are not going to be reached. That's just kind of an overview of what I think the trades will most likely work out right now. That could change, but it's been like that for weeks. Okay. So that's really good to be aware of. It's better to be bearish and sell calls right now. Any questions?
I don't have any, Steve.
No, makes sense.
Okay, great. So let's look at another trade. So this is a trade I did with IBM. This was on July 21st. This is a bearish credit spread. You'll see on the left side of the chart a great big red down candle. Whenever you see that, and you see it on high volume as you look at it down here, on this candle, the reason why you have a great big red candle on high volume means professional money is unloading this stock heavily. So you see 3, 4, 5, 10 times increased volume to sell it off. You notice that even though IBM has climbed up about halfway as a retracement over the weeks following, that's about it. It went back down. There's heavy selling pressure on IBM right now. Okay, so I did, at the time, the stock price was at 141.02 on July 21st, which is where the crosshairs are. You can see that down here. Doing a bearish credit spread, expiring almost a month later on August 20th. And I sold the 143 call for $1.55. That's $155. And $4 higher, I'm buying the 147 call, and I'm paying $60 for that. So immediately I get a $95 credit. Now, this was a beautiful trade. Everything worked out. But again, on one day, very briefly, intraday, the stock did go above 143, where I sold my call. And within, an hour or two, they pushed it back down. Now, if someone was going to be happy with a tiny profit and sell, I could, technically have been exercised, but it's highly unlikely, like over 90% odds that wouldn't happen.
So if you would have been exercised right there, though, you wouldn't have hit your option. That one would have been a worse loss because you were right in that.
Yeah, actually, let's talk about that.
Yeah,
I don't see on this chart exactly how high it went to. I think it went to like 143.50 or something on this particular day. If that had happened, I still would have made money on this trade, because even if it went up slightly against me, I made $95 to do this trade. And maybe half of that would have been taken away in if someone had exercised against me at that price. Break even is actually, let's see, $95 above 143. So 143.95 is break even on this trade. So I still would have made money. That's the cool thing about this. The odds are even more in my favor because for me to lose money, the stock has to go even higher than where the initial sell is, the initial option call is at 143. Which is great.
We've got a question. Can we take a look at potentially helping someone set up a spread for OIH and what the thoughts are on that? You want to just
okay, I'm going to have to get out of this screen. So let me go to my OIH.
OIH.
Oil sector ETF. Can you see that on your screen? No? Okay, hold on. Let me...
yeah, I see a black screen on there.
There's something.
Give me a second.
Man.
Let me...
yeah, I might have a block.
I'm still getting used to this software. Give me just a second here.
Steve, did y'all get to watch the game this weekend?
Which one? The Razorback?
Yeah.
Man, I watched the whole thing.
What a game.
It was best day of my life.
Can you see this chart now of OIH?
Yes. Let me add that. Well.
Can you see it okay, or is it too small?
Your manage is blocking it. Your shrink whatever you have in front of it.
Okay.
Yeah. I feel like there's something blocking it in the middle.
That's a black screen. Steve, can you pull OIH up?
Yeah. OIH. Oh.
I'm going to pull it out separate, so it'll be...
I wonder why that's blocked the screen. Yeah.
Okay, I think I got it. Look at this.
Oh, there you go.
Okay.
There you go.
Okay. Let's look at OIH. Let's just analyze it for a second. So first off, we got the 50-day moving average, which is this purple line. The purple line, it's showing that the stock or the ETF just barely passed up above it. It had been in a downtrend. Now it looks like it's starting to bounce above it. This is interesting. This is like a inverse head and shoulders. This looks like it's starting a new uptrend. And it's up $8 today, which is significant, 4.28%. Okay. So this looks like it could be going into a new uptrend. What do you think of this, Stephen? I'll let you take a crack at it if you want.
Yeah, I see the same thing you're saying. Is I see that it's right at the neckline. Right, you got that inverse head and shoulders pattern. Also, all week I've been looking at some oil ETFs such as IEZ, FCG, the net gas. They've all been outperforming. And what's interesting is, can you scroll back a little further on the chart? Go back further than April. So what's interesting is, you know, this is in a deeper correction than it was from March to June. Where are you at now? Yeah, there we go. Okay, that's perfect. So if you look at what happened really from March to May, like you had that pullback, and then we were playing some, right at the end of April, we were playing some of the oil ETFs, and then they really went off. Now they pulled back, and now they're starting to, the way I see it, this is double breakout scenario. That bar is starting to break above a neckline, which is the inverse head and shoulders, right? You can kind of draw that around the 194 area, kind of that trend line, right? Which is that 194 area. Yeah, a little bit higher. But at the same time, it is changing its personality. It's breaking above that 50-day moving average. And you can see it try to break popped yesterday, and then it reversed lower, and then it just completely negated that bar today and hit new highs. Based on just pure technical analysis, this to me seems like a reasonable place to swing the bat. It does, with a stop under a swing low or max 10%, because the technical events are happening, right? You're at the bottom of the base, it's clearing the neckline, and it's breaking above the 50-day moving average. The personality is changing. And when personalities of stocks or ETFs change, you need to start to pay attention. So whether you think about oil, all those opinions, they're irrelevant. They don't matter. What's happening on the chart? And the chart is showing me that it is very early. Now, the earlier you get in a trend, the higher the failure rate is, but the higher the upside, right? Because you're getting in early. But I'm seriously considering placing some oil ETF trades myself today, just because there are lots of volume are coming in and they're looking pretty strong. At least over the last week.
Okay, I totally concur with that. That's exactly the way I see it here. So there are different ways that you could trade this. You could buy the stock, or the ETF rather. You could buy a call, or you could sell a put potentially down here at the 180 level. Okay, if we're going to do this as a credit spread, we'd probably want to sell the 180 puts and then buy a lower put. The lower put that I would buy would depend on the risk-reward ratio and how much money I'd have to pay and that sort of thing. I'd have to look at the numbers. But this looks like it's got plenty of room to run up to previous highs. Okay.
And a lot of these ETFs are looking the same. If you can pull up IEO, you can see the chart looks the same, but it already cleared that neckline. That inverse head and shoulder. It cleared the neckline on Monday and kind of got shaken out yesterday, right? It got slammed, and now it's back up. And that is commodities for you. They're just gonna wear you out. That's why I don't trade a ton of commodities. I prefer the ETFs because they are just as aggressive. But I see a bullish setup.
Definitely bullish. Plenty of room to go. I think this could very easily go up to previous highs on both of these charts. So it could easily go up to around 59.60 level or higher even.
Yep.
It might take a month or 2 or 3 for that to happen, but overall it looks really good. So again, if you're bullish on this, you can buy the stock. You can sell a put. You could possibly buy a call if you wanted to. For the sake of this class, we would want to put to sell a put down here around 50. And then buy a lower put, maybe 48, 47 price range where we don't think it's going to go. Okay, but this is a beautiful setup. I really like it. Just barely crossed above the 50-day moving average, and it looks great. I like this chart a lot.
Now, I could actually flip this chart and say that it is a head and shoulders pattern, a longer term pattern, and right now we're building the right shoulder.
Yeah.
But I tend to look for bullish setups, not bearish setups. But that's why technical analysis, everyone can see something differently. But at the end of the day, it's important if you see something that looks right, you feel like you have a slight edge, swing the bat. Use your money management rules, use stop losses, use targets, use, proper position sizing. And because you just absolutely never know which one is going to be your big winner. You don't.
Absolutely. Now, Steven's absolutely right on this. Just over the last few days, this has been a very volatile stock. You had a move up, a big move down, they crushed it the next day. And then here we are up above to new highs. So this is really volatile. If you're going to trade this, trade it small. Trade it smaller than you normally would, okay? So you don't get shaked out of what would have been a good profitable trade, and you get stopped out because position size was too big. Okay, so this looks like a beautiful chart. I'm going to look at this for myself. Okay, so very good. Do we have any other stocks you want us or ETFs you want us to take a look at?
Thanks, GB. Any others? Okay.
While we're waiting, I can show you a chart that I just got into.
Yeah,
Okay, this is MGM. This is the casino in Las Vegas.
I've heard of it.
Yeah. Now, I did a stock trade on this particular one. I sold it on this day a couple days ago. And let me see the exact price. I sold it at $42.83. And already it's down about $3 a share. So why did I sell it right there? Because it's showing it's hitting resistance. Let me scroll back just a little bit. I hope you can still see that really well. There's serious resistance up here around the $43 per share level. It's hit it in the last 3 months. It's hit it several times, 1, 2, 3 times already. And then when you see it flatline after reaching this level, it's a pretty good indication it's not going to go any higher. So right there, when the stock is around $43 a share, I want to either buy a put or sell the stock short, or for the purpose of this class to generate income, I want to sell a call at maybe $43.50 or $44 a share, depending on what's available. That's my money maker, that option. Sell a call for around that price. And then I'm going to buy a call about $3 or $4 a share higher. My length of time on this, looking back, it's easy to see, but I would be very comfortable putting this out at least a month to 6 weeks. I don't like to do options longer than 6 weeks. The time decay is fastest in the last month of trading. Did you know that? It speeds up as we get closer to expiration. So time decay is pretty slow if you do a trade that's 6 months out. Okay, so I don't like to do any longer than 6 weeks, and I prefer to do it more like 3 to 4 weeks on most trades. If you capture that time decay and you're a quick profit, and get out and move on to the next trade.
So does it speed up even more? Like as the rate of the decay, does that speed up within that week as well? Like the last week, it's just
it speeds up over the last month, basically.
Okay.
It speeds up a little bit over the second to the last month, but it speeds up the fastest in the last month as we approach the expiration. And
but
so
if you're only doing it with a month, if you're only setting it for a month, wouldn't that be like this? You would be seeing the same rate of decay throughout
until maybe the last few days. Yeah.
Okay.
Yeah, but the point is it's pretty fast, and we generate profits faster by doing that, and we take less risk also. So I would much rather do, monthly trades on options that last a month and do it every month, rather than one option for 2 months, because it's safer and I'm going to make a little more money.
Gotcha.
Okay. Ben, if you see any questions at all or any other stocks or ETFs you want me to look at, tell me so I can pull them up because I can't see them.
Nothing now. No questions. Anybody has any tickers, throw them out right now and we'll look at, how to set up a spread on this. Steve, do you have any off the top of your head?
Give me a minute.
It's interesting because I'm not used to looking at the charts this way, and I guess it's just playing a different angle of it, but
anytime I look at a chart, here's what I'm always looking at. First off, number one, I'm looking at where is support and where is resistance.
First and foremost, where is support, where is resistance?
Yeah, really simple. So based on this, I'm looking at let's go to a 6-month chart. Can you see that? Okay.
Mm-hmm.
Hope so. Okay, so I see that the stock keeps bouncing off of resistance up here around 44 bucks a share, and I see bouncing off support down here about $37 a share, plus or minus. Keep in mind, support and resistance is not an exact price point. It's like a general level. It's kind of like a chain link fence. It can bend a little bit. So it's you see right on this day, the stock went above the price level, but they quickly pushed it back down. So you've got to hit its support level here, and then over here in May. Hit it again, actually went a little bit below it here in July 19th, but bounced up quickly. Did it again over here. So clearly, MGM is in a sideways range, and it's pretty obvious where prices are low and where it's high. It's really simple. So all you got to do is when it's at the top, you sell calls above. When it goes to the bottom, you sell puts below.
Hey, Greg, let's go through that same process with the ticker PG. Just came in the comments.
Procter and Gamble. Okay.
Procter and Gamble. All right, let's just look at it and be like, you know, if this was your process, for some reason you stumbled across PG, let's take a look at how you would and what you would do is setting this up.
Okay. First off, PG, Procter and Gamble, is in an uptrend, pretty obvious. It's above the 50-day moving average, that purple line.
Mm-hmm.
Let me zoom in a little bit more, make it a little easier to see. One thing that I notice is that it has stayed well above the 50-day moving average. Every time it doesn't even come close to hitting it before it starts to go back up again. Okay, so the way that I would want to trade this is I'm going to wait for this type of setup to come right there. Keep in mind, Procter & Gamble is a huge conglomerate, enormous company, just gargantuan company. So we've got a pullback from 145 down here to about 142. It's only $3 a share. And then you see it go down and then start to go sideways for a few days. It's a pretty good signal. It's probably going to start the uptrend because it's in a strong uptrend. So based on that, I would want to sell a put down. Let's see, that price is 142. I'd probably sell a put at 141 or 140 and then buy a lower put for protection, say 138 or 139, something like that. I'm only going to do this trade if the risk versus reward is worth my while. If I think there are low odds the stock is actually going to go down there, and it's far enough away so that any jiggle room, I call it, for the stock won't get me out of the trade or get me exercised. So right here, I don't want to place a trade. I want to wait for it to come back down, to trade with the trend, to be bullish, and then to sell a put below. And I'm going to be watching very closely to see if for any reason the trend is changing on this. Right now it's not. So that's what I'm going to do the best I can to put the odds in my favor for a profitable trade. That's what I would do on this particular stock.
Gotcha. Thank you.
Now, you could sell a call. It went up to a price of about 146 and then started to come back down. I don't like that trade because you don't know if this is just a 2-day pullback and it'll zip right through your strike price and go back up. So it's in an uptrend. I want to respect that. I want to wait for this setup and then sell a put as long as it's in an uptrend. That's the only way I want to trade this.
Perfect.
Does that make sense?
Yes, absolutely.
I got a stock, PLTR.
Okay.
That's
Theory. Okay.
Yeah, this is one I've been kind of bullish on. It's got a little cup with handle pattern going on as of recently. You can see the volume, the huge volume spike early August. That was an earnings gap. I had it and I raised my stop to break even. I think I hit 8%. I raised my stop to break even, and then I just got hit the other day, 2 days ago on the most recent red bar. So out for a small gain, but it's looking like it's trying to come right back. You can see the moving average. The red bars are finding support off that middle Bollinger Band. So, and that is also, that middle Bollinger Band is also where the 200-day moving average is, which you don't have it. So it seems reasonable to me, right, that I would want to sell a put below that, what I think is support, and then buy one a little bit lower. Was that?
Okay, the green line is the 200-day.
Yep.
Okay. What I notice about this is it's bouncing off ever since earnings day. It's bounced off the 50.
Yep.
So yeah, this is definitely a bullish pattern, but it does have these pullbacks. Here's something that would be worth looking at, Stephen, is if you saw a previous time where Palantir did beat on earnings, how did it act in the, say, 2 months after that? So I don't know the answer to that.
Yeah, so right at that swing low, that big reversal bar in early May, right under, yep, that was an earnings report. It was bullish, and it rallied, right? And then you had another earnings report.
Looks like it rallied for 2 months with just little pullbacks.
Right.
Nice.
So then that other pop with the big volume bar rallied again.
Okay.
It's trying to rally. I think the market's kind of getting a little choppy, a little under pressure. It's kind of what's holding it back.
Yeah, the market definitely is choppy right now.
Yeah, it's kind of going. It's doing some tugging and pulling. So that's why I'm like, okay. And sometimes you have to look at the overall market. You know, like I think this is showing that it's holding, but at the end of the day, this is a growth stock. It's an aggressive growth stock. If the market rolls over, it's probably not going to hold.
Yeah, let me give you a little statistic on that. Long term, over 90% of stocks are going to go up when the market's going up, and over 90% are going to go down when the market goes into a bear market. Okay, stocks move together up and down.
Right.
In the long term, but in the short term, all sorts of little wiggles happen and stuff.
Yep.
Okay. So, you know, if the market crashes, it's going to take everything with it.
Yep. I agree.
Okay. Yeah, I've done studies on this, and that's what happens. Okay. So, yeah, definitely bullish on this. Looks good. Let's just pull up something else.
Here's a question on Disney.
On Disney?
I'm gonna put this up on screen. Can you read that, Greg?
Say that again.
I said I put this question up on the screen. Can you see that?
Let me go to that screen here. So you sell a put below support. Disney from last week looks to going in your predicted direction. At what point would you consider closing early? Okay. Let me go back and look. Okay. So as long as let's talk exit strategies for just a second. If let's say I sell a call up here around 185 or whatever it is, if the stock has a big move down and I can profit quickly, I'll do it. Absolutely. So if I could get maybe 75, 80% of the profits that I was planning on getting, well, that's great. I can ring the cash register right now. I can take my profits and go on to another trade. And I do that all the time. Okay. You're taking on extra risk of the trade turning around on you if you hold and you're only making a small profit left in the trade by waiting to expiration. At some point, it doesn't pay to do that. It's good to just get out, take your money. The stock moved in the expected direction. If you don't think you can make more out of the trade, or you're happy with a quick profit, go ahead, get out. I do that all the time, but then sometimes, I just let it expire if it's close to expiration and not bother having to exit. Kind of a judgment call on that. I go into every trade expecting to let it expire for a full profit, but that doesn't always how it plays out.
Mm-hmm.
Does that make sense? Any questions?
I believe so. Monica, let us know if we covered on that. Two more tickers.
XLY.
Yeah, you can see that. Okay.
Consumer Discretionary Select Spider, ETF, XLY. Okay, definitely in an uptrend. In the last month or so, it has not held the 50-day. So this is in a really broad, slow uptrend. In fact, it looks like it's starting to go sideways. So I would say, based on this chart, that I'm going to want to perhaps sell a call up around 185, maybe even 184. And that's probably what I would do right now, actually.
Yeah, I'd like to throw something in there. This discretionary ETF, it is highly correlated with the market, right? It's just a big basket of stocks. Doesn't mean it's always going to move 100% in line, but to me, it's very similar to the S&P 500. So it's just kind of something to keep in mind. If you're bullish or bearish on the S&P 500, this is really going to track it probably pretty well.
Okay. So it sounds like you could essentially do the same thing for the diamonds, the spiders, or the Qs. Do you guys know about that? Those are the index tracking ETFs. I've got one of them up right here. They call it diamonds, the symbol DIA. This tracks exactly like the Dow Jones Industrial Average. Okay, so Dow is still barely in an uptrend, although it's pulling back right now. I would be hesitant to enter a trade on this at the moment because I don't see an exact support or resistance level where I want to get in. It might keep going down or it might reverse, and I can't tell which. So I don't want to place a trade if I can't make a decent prediction on it. So there's that one. What was the other one? The symbol on the second one?
Before we go there, so Monica followed up asking if we should close the position on Disney.
Oh.
We last week discussed October expiration. Should we close that position now? Is the question.
Let me take a look at it again here. I forgot what the strike price was that we placed on that. Give me a second to look at it. Can you tell me? Or I'll look it up. Hold on. Did a 185 call, I think, was it? Yeah, I think I would. You're in a profit. It's in an uptrend. I would lock in profits right now.
190 and 195.
You sold a spread at 190 and bought at 195?
Correct.
Okay.
Okay. And what was that other?
So is that a yes on Monica at the 190 and 195, Greg?
Yeah.
Okay.
Yep. Yep. I think I'd get out.
Book a small profit?
Yeah.
Good deal. The other was ALGN on a bear call spread. Excellent.
ALGN? Say that ticker again, please.
ALGN.
ALGN. Okay. Okay. Stock is definitely in a strong uptrend. Pulling back right about now. I would call that level 670 as support. So I think I would wait for it to turn around like the J. So I want to see it go down and then turn around like right there, or right there is, want to see it start to go back up again, and then sell a put below, thinking the uptrend is going to continue. We got 1, 2, 3, 4, 5 down days in a row. You don't want to sell a put into a trending down trade because it might just blow right through and you'll lose your money. Wait till it shows support. Wait till it starts to turn around. Then sell your put and do your credit spread. As it turns around, make sure it's, holds support and goes sideways or up for at least 2 or 3 days, then place the trade. That's the safest way to do this. You could jump right in now and do an at the money put, but your odds of success are pretty low if you do that. I wouldn't recommend that. I want to wait it for it to turn around, show me it's going back up, or at least hitting a support level, going sideways, then sell a put below for income.
Perfect. Thanks, JB. Or excuse me, GB. Any other tickers we want to look at? We got about 3 minutes left.
Ben, you should go ahead and tell them get them excited about what we're planning and what we're planning on doing with the alerts and with
Sure. So
channel.
Right. So next week, guys, things may look a little different. We're working out some details on starting, some alerts with this, as well as running a portfolio that you guys can watch. The last 2 weeks, we've just kind of been getting comfortable with everything and getting some, some of the details ironed out. But next week, we really want to start running a portfolio that you guys can watch and sending alerts. I will get the details out to you early this week, but keep watching. I appreciate your patience so far. Again, this is just, free information that Greg's putting out there to help you guys to take a safer approach to options. Again, Steve and I have been, running the support on the Traders Plan for a long time. We've sold options, alerts, and we have seen what can happen on the dangerous side of it. There is a lot of money to be made, but taking the safer approach, you can turn this into an income system versus a swinging for the fence system. And that's what we're here to do and here to help you guys with. So next week, tune in on Wednesday, mark your calendar, and we will start running something that you guys can follow. Thank you, Greg.
Okay.
I've got any other tickers.
Well, if any of you want to tell us anything we can do that will help you, that we can help teach you, besides what we're doing, if you have a particular interest in how we can help you, let us know. We're open to suggestions. We want to help you the best we can. Okay.
No, that's absolutely right. The best thing you can do is give us feedback on how we can help. Thank you, Monica. And hey, nice job with the win. Nice job. I'm assuming that you got out of Disney at that point and booked a small profit. So if that's the case, well done.
Hey, that's okay if you have a small account. If you're careful and wise about it, Monica, you can build it into a big account over time.
Yeah, and that's a great point, because that was another thing that came into our inbox a lot was questions about how to grow a small account fast, and it's like the reality is you want to grow it effectively, not fast. Fast is dangerous and can blow it up.
Right.
Monica, I think we are, just depending, everybody's account size is different, but I think we are planning to manage a smaller account and show smaller positions. Some of them, just depending on where you're at in other trades or how high it is, maybe out of range, but the majority should be in. I think you'll be okay. Because a lot of these would be smaller trades or something you could take one contract with. I did get into Disney and it is profitable. Well, good. That's perfect. How do we get on? Michael, email me at support and I will make sure you're on the list. So we have to create a new list for the alerts. If you come next Wednesday, you'll know all about it. But if you email me at support@thetraders.plan, I'll make sure you are. We're just creating the pages to flush all that out. I may be a little premature on this, but this is what's happening next week.
Okay, awesome. That's all I've got, unless someone wants me to look at another stock. We're at the 1 hour mark.
Okay. I will, Michael, support at the Traders Plan. Let me drop that. Anybody who wants to make sure that you are on this list, support at thetradersplan.com. And this class is happening every Wednesday at 9 o'clock Central. What's up, Steve?
I was going to say, Greg, touch base with me after this call, if you can give me a call.
Sure.
Okay.
All right, guys. Thanks so much. Appreciate everybody. We'll see you next week.
All right.
Friday. We got class Friday, too. Friday morning, 9 o'clock with Steve and Greg. Different topic, same group of awesome people. Thanks, everybody.
Thank you.
Ya.